Good afternoon, everyone, and welcome to Good afternoon and welcome everyone joining us from across the Gulf, India, and the wider global markets. I'm delighted to have you with us today for what I think is going to be a very timely and important conversation. I also take a moment to welcome our panelists, Mr. Sanjeev Phadke, Mr. Sandeep Daga, Mr. Rajasekar Krishnaraj, and Ms. Neha TU. Today's webinar is brought to you by two organizations that bring deep expertise in metals, recycling, and market intelligence. Waste and Recycling Magazine is a leading trade publication covering the recycling and waste management industry across the Middle East, India, and beyond. It serves as the definitive voice for waste management professionals, recyclers across all streams, traders, and industry professionals across Asia. And BigMint is one of the most trusted commodity intelligence platforms, providing price assessment, market analysis, and data-driven insights across steel, ferrous, non-ferrous, agriculture, and logistics value chain. Now to the topic, rising political tensions in West Asia are reshaping global base metals trade flows, trade economics, and supply chain reliability, with implications that go far beyond logistics into price formation, regional availability, and procurement strategy. Today's webinar is designed to give insights on what geopolitics means for your business and what you can do about it. Before we begin, a quick note for our audience. Please use the chat box to share your questions for our panelists at any point during the session, and we will do our best to address as many as possible, particularly towards the end of our discussion. I also want to take a moment to mention an exciting upcoming event for everyone in this industry. Media Fusion, the parent company of Waste and Recycling Magazine and the leading events and media company based in Dubai and Mumbai, is proud to bring to you the second edition of the Bharat Recycling Show. India's premier platform bringing together recyclers, technology providers, and policymakers from across the non-ferrous, ferrous, e-waste, battery, end-of-life vehicles, and tire ecosystem from August 31 to September 2, 2026 in NESCO, Mumbai. Next slide, please. As a precursor to the Bharat Recycling Show and the co-located Plastic Recycling Show India, Media Fusion joins hands with Maharashtra Pollution Control Board to organize the Recycling Vision Series, a series of seminars to be organized in Pune, Nagpur, Nashik, and Ratnagiri. The first of this series will be held in Pune on April 27. Please check out the chat box for more details on the BRS and the registration details for the upcoming Pune edition. Now, before we open the panel discussion, I'm delighted to invite Ms. Neha to set the stage for us with a data-driven presentation on what is actually happening in the aluminium market right now. Neha is a research analyst at BigMint, covering the aluminium value chain with a focus on primary aluminium, scrap, secondary alloys, and downstream markets. She has over 3.5 years of experience in market intelligence, including price tracking, supply chain analysis, and industry engagement. Neha, the floor is yours.
Thank you, Ketna, for that invitation. So let me just take a moment to share my screen. Yeah, I hope it's visible, right?
Yes.
So before we dive into today's presentation, let me just take a quick minute to tell you what BigMint is all about. I think already Ketana has given that introduction, but let me just take a minute and just explain it further. So we are actually a trusted platform that provide price reporting, market intelligence, and consulting specifically for commodities. We cover a wide range of markets like ferrous, non-ferrous metals, coal and energy, scrap recycling, logistics, and agriculture. And our services include price indices, future data, news and insights reports, tenders, events, consulting, and even price forecasting. So now before we jump into the presentation, I just want to give you a quick overview on what we'll be covering for the day. So we'll start by looking at how base metal prices have reacted to the ongoing tensions and what really is driving these moves globally. And then we'll touch upon which metals are more exposed and where the risk is actually building up. And finally, we'll bring it back to India and what this means for our market and how much exposure we really have. So starting with the global supply picture across base metals, the impact of the West Asia conflict varies quite a bit by metals. So for copper, the direct impact is actually limited since the Middle East isn't a major producer, but the real impact is indirect through logistics and trade routes. Disruptions around the Strait of Hormuz are leading to delays, rerouting, and higher freight costs. And at the same time, the market is already tight due to constrained mine supply and limited concentrate availability. And the treatment charges have also even turned negative, which is keeping the prices firm. So overall, even without a major supply shock, we're seeing tighter availability, higher premiums, and increased volatility. And now, in case of zinc, it's slightly different. Here, the impact is slightly more direct. Like China, which is the largest producer, depends heavily on imported concentrates for zinc, especially from Iran and Russia. And these two countries account for about 15% of China's overall zinc concentrate imports. So, with disruptions in Iran and weaker supply in Russia, we're seeing a double impact here, tightening raw material availability for smelters. And since China is so central for the global market, it could translate into lower refined output and higher global price volatility. But aluminium is where the impact is more significant, as the Gulf contributes around 8 to 9% of the global supply and exports most of it, and making it a critical hub. So we're already seeing actual disruptions with major plants like EGA and Alba being hit. And EGA has also provided a statement saying that it could almost take 12 months to fully get back online with operations at its Abu Dhabi plant still impacted. And at the same time, shipping through the strait is heavily disrupted, affecting both raw material inflows and exports. With already lower inventories and limited global buffer, this combination has kept the aluminum prices firm and very volatile. Now, if we look at how this is translating into prices, copper prices have corrected quite sharply, like from around $14,000 per ton levels to nearly 12,000 levels as of now. And this is largely due to the demand that concerns, especially with higher energy prices, raising fears of slower global growth. And at the same time, global inventories altogether have crossed 1 million tons, and this is the highest since 2004, and this has further added some pressure. So the near-term prices are quite softer, but volatility remains due to the ongoing supply risks. And in case of zinc and lead, the price movements have been relatively moderate. Zinc prices have seen about 3 to 4% of an increase due to supply concerns and risk premiums. And although gains are capped by weak demand, lead prices have moved up briefly but softened again because of the oversupply that we have seen. And coming to aluminium, which has seen the strongest price movement this time. So prices had already trended up by the end of 2025 to almost close to $2,800 per ton. It was driven by the European smelter closures, China's production caps, globally low inventories, and a few smelters that failed to secure power supplies and all. So with West Asia tensions, the prices have surged to almost 3,400 to $3,500 per ton, almost 20 to 25% increase. And it corrected towards the mid-March to around 3,200 to 3,300 range. But after the recent hit on EGA and ALBA, the prices have again spiked, and it's hovering between 3,400 to 500 levels. And this is clearly showing us how sensitive the market is to supply disruptions. And also mentioning that this has also pushed the global premiums to very higher levels. So now if we bring this focus on to India, we're clearly seeing that global trends are reflecting in the domestic market as well. And for copper, zinc, lead, the direct impact is quite limited, with prices largely tracking LME and MCX trends, though higher fuel costs are adding the overall cost pressures. But when we look at aluminium, the impact is quite visible in India. And I would also like to add that India is importing almost 30% of its ingots from the Middle East out of the total input. So these disruptions are tightening the domestic market as well here. And but in another way, it can be beneficial for the domestic producers as it's increasing the reliance on local supply. And at the same time, producers are also facing higher costs due to rising fuel and gas prices. and this is pushing the aluminum prices and premiums in India higher. And if we look at the downstream segment, the pressure is even quite sharper. Prices of raw material has gone up to 30,000 to 35,000 per ton in just within a matter of few weeks. And energy remains a key concern across all base metals, with LNG availability here at 70 to 80% of the actual contracted volume with the companies. And switching to alternative fuels, potentially it increases the cost by around 20 to 25%. And if you look at the exports, that is also getting impacted as few downstream producers in India ship their production majorly to the Middle East markets. Now, if we move on to the secondary segment, here it's more visible in terms of scrap. So Middle East almost accounts for 20% of India's non-ferrous scrap supply out of the totally imported volume. So disruptions here are quite noticeably big, and especially for aluminium and copper, key scrap grades like TENS, Tain Tabor, extrusion in aluminium, and copper scrap grades like birch, mulberry are impacted, as these are majorly coming from the Middle East region. And in aluminium, secondary prices, especially ADC12, aluminum die-cast ingot, which is used in automobile for making engine parts and all, it has moved up sharply, the prices. And this is driven by both the domestic demand and especially auto segment, where the demand is quite high, especially post the GST changes in India in September 25. And scrap availability has also become an issue here because India is a net importer of aluminum scrap, and we 85% depend on aluminum scrap imports. And remaining 15% or so is the domestic generation. And India's total aluminum scrap in 2025 was around 1.92 million tons. But after October 25, the scrap imports into India has consistently seen a decline on a monthly basis from 0.2 million tons in October to around 0.1 million ton by Feb 26. So this is majorly due to higher LME levels, currency exchange rates, and West Asia conflicts has now been further adding up to this. So now coming to copper, the impact is again indirect, but it's quite important because India imported around zero point 0.3 million tons of copper scrap in 25, with about 19% of the overall imports coming from the Middle East region. So the disruption in Gulf logistics can tighten scrap availability. But however, supply of scrap into India for copper, especially from the western region, is coming in, and the availability is not quite impacted as like how we saw in aluminium. And now if we look at zinc and lead, exposure is quite low. Scrap imports from Middle East account for about 10% from for zinc and around 8% for lead. And India majorly does not import scrap in terms of zinc and lead. They come as semi-finished into India, that too from the Asian regions. So here the impact is quite indirect, but the market still remains sensitive here because of the trade disruptions. And just to add on, we as a recent update, we heard that some ports in the Middle East region are partially operational and have resumed exports, but although the shipments are still facing delays. So overall, if we look at the outlook, we're seeing supply conditions have somewhat improved around base metals, especially for copper and zinc, where inventories have slightly recovered. And if we look at aluminium, it structurally remains tight because of the supply disruptions and logistic challenges. And new capacities in Indonesia that we were expecting, they are expected to come online by around towards the end of FY27 or maybe early to mid 28. So there is a limited near time relief. And lead continues to face the oversupply. So the prices are going to be relatively soft. So overall, aluminium looks firm, lead is expected to stay soft, and copper and zinc should be moderately volatile, with the geopolitical issues continuing to play a key role. And to take these discussions further, BigMint has actually brought together a dedicated platform for the industry. We are hosting BigMint India Non-Ferrous Week 2026 on 9th and 10th of June in Mumbai, and bringing together the entire non-ferrous metals and recycling ecosystem to discuss market outlooks, trends, and opportunities in depth. And for all of you who have joined us today on this webinar, we've put together an exclusive offer. You get a 10% off per delegate on the registration fee. And if you register two delegates, you unlock an additional 10% off. And now here's the important thing that we'll have to keep it in our mind. This offer is valid only for today and tomorrow, and it's exclusively available if you register through the link shared in the chat box. So please don't miss this out. It's a very limited time benefit for you, and looking forward to see you all in Mumbai. Thank you.
Can
Ketna, you're on mute.
I'm sorry. Thank you, Nega. That was a comprehensive and data-rich picture of where the aluminum market stands right now. Now we move on to the panel discussion. Let me now introduce our full panel. Joining Neha on today's panel are Mr. Sandeep Daga, the founder of Regsus Consulting, a commodity price risk management advisory firm. He also runs the Metal Intelligence Center, a platform providing news, research, data, and analysis on base metals. Mr. Sanjeev Phadke is the managing director of Metaal Europe International, based in Sharjah, UAE, a well-known exporter of quality recyclable materials. He is an executive committee member on the board of Bureau of Middle East Recycling and currently holds the position of the treasurer. Next, we have Mr. Rajasekar Krishnaraj, who is the head of sales at Pan Gulf International Metals Industry, bringing nearly 2 decades of experience in the metals and recycling industry. He has previously worked with leading global players such as Vedanta and Korea Zinc. Before we dive into the panel discussion, I want to take the pulse of our audience. Please take a moment to respond to our first poll that appears on your screen. Admin, can we have the poll question? Yes. So you can take 30 seconds to answer. What do you see as the single biggest risk to base metals markets from the West Asia disruption? Physical supply shortage, freight and logistics breakdown, price volatility, or counterparty and contract default risk? Can we have the results, please? Yes. So that's interesting. Most of them have felt freight and logistic breakdown as the biggest risk. But let's hear it from the panelists as well, what they feel about the situation. And once again, I welcome the panelists. Let me start with Mr. Daga. From a risk management perspective, how does this disruption compare to previous recent geopolitical shocks such as the Red Sea crisis, the Ukraine-Russia conflict, in terms of impact on base metal supply chain? Mr. Daga?
Yeah, thanks, Ketana. I think every crisis brings two kinds of shocks. The first is on the present-day demand and supply, which can create physical shortages for ready availability of. And the second one is a worry about future demand and supply, which largely affects the future prices. So you mentioned about the Russia crisis of 2022. That crisis had more of a future demand shock or future supply shock impact rather than a present day impact. So people were worried about potential US sanctions on Russia and thereby, supply shocks in terms of aluminum supply from them. However, the logistics were fine. There was no present day crisis. There was no shortage. And because of which we found that the premiums did not lift as much. The prices lifted much. Because as you remember, it happened in 2022. And in the post-COVID journey, economies were rebounding very, very sharply. So the demand was very strong that point. So an event like this really created a big future shock for the people. Therefore, the prices lifted up to a record high level. But if you look at it now, it's more of a present day supply shock. As Neha said, the problem, especially in case of aluminum, is pretty big because we find the Gulf region to be large exporter of aluminum to the rest of the world. And aluminium, as we know, is the largest base metal. I mean, 75 million ton of consumption of aluminium annually in the world is more than all other metals put together. So this shortage is really big, and because of which we have seen that the premiums have lifted further, the backwardation have expanded, the nearby prices have moved up sharply while the far forward prices are moving lower. So this did not happen in 2022, or slightly different from how it happened. But from risk management point of view, what I gather from my clients and the questions that they are asking and what they're trying to do this time is that, firstly, there's an urgency to expand the list of suppliers. People are acknowledging that commodities are always vulnerable to geopolitical risks. It can happen from one region to the other region. So having your customers and your vendors in different places always helps you hedge that bet, which you cannot hedge in future months. That's one. Secondly, I think people are looking to hedge premiums. As I say, the prices have not really shot up that much this time, and people could absorb these price shocks, but the premium shock was too big for them to absorb, especially when they cannot hedge it. So they're looking at avenues to reduce this risk in future. However, the biggest element which existed in 2022 and happening now is that those people who were not disciplined hedgers, they have got a shock. And they have now very, very little risk appetite to predict prices and hold their views. So many of those people are desperate to go back to disciplined hedging. To me, I think that's the best outcome out of this crisis. People get a disciplined hedger. That's a fantastic thing that would have happened.
All right. Thank you for that insights. Let's move on to Mr. Rajasekar and Sanjeev, who are actually in the middle of the heart of this disruption. So let us now get the ground deep reality from them. Mr. Rajasekar, what are you actually seeing on the ground right now that the market headlines are actually missing in terms of trade flow disruption, sourcing stress, and buyer behavior?
Yeah, Neha, thank you for the introduction. And see, in terms of the trade flow disruption, the things are not stopped, but it is not clear. It is, very, very highly fragmented. Probably this is the first time. I mean, we had similar shocks in the past when Ever Given was grounded, blocking Suez. And then late in 2024, 25, we had this Red Zinc blockage. But what is happening this time looks to be much bigger and more in terms of blocking the Persian Gulf. Because majority of the ports, say for example, Jebel Ali, one of the world top 2 or 3 port that is lying in the Persian Gulf. So we don't have an immediate replacement for a volume of this kind. So what we see is there are vessels calling from Kofakan at times, started moving to Sohar, and even some of them started shipping and importing into Jeddah from Red Sea. So we see all of this happening on the logistics side, but it is not. Nothing is clear or firm until it actually crosses. And what we also need to notice, more than 200,000 boxes or 250,000 boxes is trapped inside this Persian Gulf, which is probably will have an after effect in terms of repositioning of boxes. Okay, so today, if you look at the freight, the cost, the major problem is the war risk and the insurance that needs to be taken care of. So WRS is like revised, and the other fuel surcharges are revised every week or every 14 days. So today, if you look at the landed cost, for a supplier to work here, it is usually the freight plus the fuel surcharge plus the war surcharge plus the cost of working capital. You are not sure when you can buy and when you can ship. So movements are happening, but maybe I would say 5% of the total 100%. When you look at the supplier behavior, supplier behavior is slightly, in terms of we supplying to India, our approach is asking for a wider shipment time wherever possible. and keeping the price open, or try to price it as and when the vessel is on board. From a buyer perspective, is very interesting to see. I mean, the demand behavior is behaving very differently, which is supporting the cost now in the market. Okay, I mean, the market looks to be completely inelastic, but I would say in short term it's going to be a low elastic, in terms of the demand behavior. So the market is actually not short of metal. It just it's a lack of confidence and the reliability factor that's being built. So today people pay price for the premium, not for the metal, but they pay for the reliability, your certainty to ship.
Right. So do you agree with the audience that logistics and freight breakdown are the biggest issues right now?
I really can't agree more. I think everybody is feeling the pain. That's why I see 67% of them voted for freight and logistics, because some of the points that's actually close the entire trade flow is the Strait of Hormuz. That is the epicenter of the problem.
Right, right. Mr. Sanjeev, coming to you from an exporter's perspective, are you able to move material out of the region, and what is happening to your buyer relationship and order commitments when delivery suddenly becomes uncertain?
So, see, for most of us, this situation was, I mean, it came out of nowhere. And therefore, none of us were prepared with any other alternative arrangements. And thinking about the exports from Jebel Ali, the system was so simple and so well laid out for so many years that a lot of exporters were working on an auto mode. There was hardly any planning to be done for when is the vessel, how are the sailings available, what kind of documentation is required. Everything was all well set for most of the exporters. So the first and the foremost challenge for exporters was to understand what is happening. And we have a lot of people who have our cargoes stuck in the port. Some cargoes stuck on the vessel which could not sail out. So more than bothering about the new exports, the first few weeks have gone thinking about how to manage getting our those containers back from the port. Having said this, the new routes for exports are being worked out. The governments and the government agencies, particularly in UAE, have been very, very proactive in finding alternate routes within UAE as well as through Oman. But the challenge is with every new customs, with every new port, with every new country, the procedures are not familiar. So one has to really understand those procedures, prepare yourself, and because the alternate routes and the alternate ports that are being worked out do not have the capacity of handling the containers that Jebel Ali port had. And therefore, you need to really plan for the congestion at the port, when to call the empty containers for loading and sending them back to the port, whether you have to send to a port of Khorfa Khan, which is distance-wise only a couple of hours, or say 3-4 hours drive, but you cannot predict how much time the truck will have to wait there in queue to actually enter the port. So these are really the new challenges that every exporter is currently facing, and these are all very new challenges. And there is no yardstick yet for either a big player or a small player to say that, okay, do like this and things will go, in the smooth manner. And therefore, the question of the commitment, the question of the order execution is right now, in my opinion, a secondary thing. And as perhaps your survey also suggests, the biggest challenge for everyone is finding the logistics and a sure short way to know whether the cargoes are actually going to move. As Raja also mentioned that they are talking about widespread delivery schedule, but then it's very easy to say widespread, but then it's a challenge, for bigger the players, the bigger are the challenges.
Right.
Other thing that brings me back to Sandeep, when people were buying recyclable materials from Middle East for Indian market, neither the customers nor the suppliers from here we ever thought of the need for hedging, because the hedging cost was more than the cost of shipping to India. I mean, I'm saying this jokingly, but this is more or less the fact. The shipping cost was next to nothing to India, and therefore a lot of people believe that hedging makes no sense for getting the cargoes from Middle East to India. But now with this situation, what Sandeep says makes a lot of sense, that both buyer as well as the exporters need to really think of hedging. Hedging for shippers here, because people like us with yards, when we are buying material locally, we do not know when this material will actually go out of the country and will actually reach the destination. And this is bringing a lot of the new thing that nobody has any experience of.
Right.
Even talking about hedging, sorry, I'm taking a little longer, but when you do hedging, you have to tell your broker for what period you need the hedge, and for every period there is a cost of hedging. Now, if you have to roll over, there is also a cost. If you have to cancel, there is a cost. And already the business is very, very low margin business. So all these costs, unexpected insurance premiums, unexpected surcharges, ever increasing sea freight, lesser availability of the ships, it's a big mess right now.
Right. Absolutely. This is unprecedented for everybody involved in the industry. And later in the discussion, we will ask Mr. Sandeep to give us concrete steps on how to go about this hedging and the challenges. Let us now get deeper into the recycling and secondary supply chain specifically. Mr. Rajasekar, coming to you, how are scrap and secondary metal flows in and out of the Middle East being disrupted? Are recycling supply chains being hit differently from the primary metal supply chain?
Okay, yeah, I think we have already spoken about the disruption and the logistics. So obviously the answer is yes, it's greatly affected. But how is secondary different from primary, and how it is now greatly affected from a relative perspective is what we have to look at. See, if you look at primary, it's usually the brands that is associated with. If you have a brand that is registered, and if you could be able to switch the origins, it doesn't actually make a bigger difference from a quality perspective. So that is where you can move metals easily with primary, but it usually comes with a larger balance sheet and a long-term contract. So primary, there is a shortage because of the region not able to ship. But buyers, from a buyer perspective, if they could able to take it from other places, they could still manage it. But while coming to secondary, you have to we all have to understand that it's a very, very highly fragmented market. the entire ecosystem or the supply chain works, smaller collection points, quick cross-border movements, and flexible in terms of all the other factors. And you should also understand that the scrap it doesn't conform; it only conforms to a certain attachments and purity, and the scrap quality varies from different places: European quality, US quality, and UAE quality. So it's not that this market can or the buyers can usually adopt to those changes.
Right.
While talking about inbound, you see most of the scrap is generated locally here. So UAE is not major hub. EGA is planning to put one. They've already on it. But otherwise, there is no major imports of secondary happening into the region, except for there's a lead smelter which imports some lead ingots. But what we also have to see is the local consumption here. Say, for example, Middle East is one of the major hub for ADC toile into Japan. Okay, you've also seen the ADC prices going up, but nobody is going to take a benefit of that because people stop buying tenses because they don't have a surety about shipping those cargoes. The other point is, one more major point about secondary is the substitution, which is quite easy in primary, which is not easy when it comes to the secondary market. So in a situation like this, my take would be the primary usually looks for adjustment. They could adjust it, but the scrap market usually freezes.
Right. Mr. Sanjeev, staying on the topic of secondary metals, you had touched upon the topic of how this disruption is impacting the businesses in the Middle East specifically. So as a treasurer of BMR, you have visibility across the entire regional recycling industry. How is the industry coping now? Are smaller players feeling the pressure more? And do you think they will be simply cannot survive in an extended period of export disruption? Is the situation that bad, or how do you gauge the situation now? Severity of the situation.
Okay, so to begin with, I must clarify that we are talking about the ferrous and the non-ferrous recyclable materials that are getting generated, processed, and exported from the Middle East. As BMR, we have been very proactively in touch with our members here. That includes the recycling factories, the collectors and the processors of scrap like us, and the pure traders who are just buying and selling. Just a week ago, we also held a very important and critical webinar on maritime rules and regulations and maritime insurance. The two very, very major topics today, because things like force majeure. Force majeure is spoken so commonly that you hear this. Even our vendors coming, bringing 2 tons of material, says because of force majeure, this is the market, and he does not understand what force majeure is. Not to demean the vendor who brings 2 tons of materials to us. We all realize, even the biggest of the exporters from Middle East who were part of that webinar, we all realize that actually none of us knew what a force majeure is and how a force majeure can be can be put in place. So I think problems like these conditions give you the opportunity to actually learn what you have been talking about. Things like insurance. Now, most of the people, we thought that we have proper insurances. But then war risk is an insurance that is not always covered unless asked for. And how how it is applicable, for what duration it is applicable. Nobody bothered all these years because nobody ever imagined that there could be a situation like this in this part of the world. So the positive side of this is that because of this problem, a lot of us actually got to learn these new things. So this was talking about the BMR. That BMR is very proactively trying to make people aware of the rules and the regulations. And they are we are in the process of collecting the questions and the complaints and the challenges that our members are facing, and we are trying to address them through the relevant authorities. Having said this, you see, this cost escalation due to the surcharges and the higher insurance cost has made certain types of metal scrap export totally redundant. There is absolutely no chance of exporting those scraps. Things like ferrous scrap. The commodity price itself is hardly $300 to $350 or say $400. And the escalation in the cost today is nothing less than say $200 per ton. Now, with $200 per ton escalation in the cost of shipment and insurance, no ferrous scrap is going to be viable for exports. The only solace for these people is that there are steel mills within Middle East who are consuming ferrous scrap. So they have some market here within the GCC to move their ferrous scrap. But again, the domestic transportation costs have also gone up. Even in the domestic transportation, insurance providers are recommending to cover war risk. So overall, the cost is going up, and one has to see for which kind of scrap or recycled material these escalation in the costs are viable. And it does not really matter whether the player is a small player or a big player. A very, very light remark. Once I narrated, to a friend that I have small children. When I was younger, I have small children and I have problems to handle. And this old wise man at that time had told me that, young boy, wait till you grow up and your children grow up, and you will realize that with grown-up children, the problems also grow bigger. So likewise, for bigger exporters, the problems are big. For smaller exporters, the problem are small. In proportion, everyone has problem that nobody knows how to tackle. And the best thing is BMR is trying to gather all people together and offering a platform to kind of discuss the issues so that people can come to some kind of some way out which everyone is adopting.
Right. Thank you for that. Let us now look at what the data and market signals are telling us. For that, I turn to Neha. Neha, you presented the broader picture. Let's now drill into the specific market signals. How are global aluminium prices trending in response to West Asia disruption, and how do physical market premiums compare to LME benchmark prices? Is the exchange price telling the full story?
Yeah.
Neha.
So aluminium prices have moved up after the West Asia disruptions, and especially since the market was already tight structurally before we got into these disruptions. And this conflict has further added the risk premiums, and mainly due to these concerns around the supply from Gulf region and key routes like Strait of Hormuz, like how Sanjeev ji and Sandeep ji were mentioning. And at the same time, we've seen LME stocks also dropping like nearly 15% on a quarterly basis compared to the last year. And this is really showing us how tight the supply is. And what is more interesting is the gap between LME prices and the physical market. So physical premiums are gone up much more, but showing real tightness and delays in supply. And overall, if we see LME shows the trend, but not the full picture, I'd say. The real tightness is more visible in the physical market itself. Yeah.
Right. Neha, staying with you on the inventory question, which is really the key indicator of whether this is a real tightness or sentiment. Are inventories in India or the wider Asian market providing any buffer right now, or are we beginning to see signs of physical shortages emerging? Please comment on all the base metals if you could.
Yes, yes. So looking at India, especially on the primary metal side, we don't see quite any shortage in the primary metals, and especially aluminium and all, because we are having the production at full capacity, especially for aluminium. If we see, India is producing about 4.2 million tons of metal, and similarly with copper, zinc, and lead as well. But on the other side, if we see, we have the secondary market. In the secondary market is where we are seeing the major shortfall, especially for scrap. So majority of the material that's coming into India in terms of scrap, be it aluminium, copper, zinc, lead, it's coming from US, UK, and the Middle East region. And Middle East is accounting for about 20% of the overall non-ferrous scrap imports out of the total. So it is definitely short here. And in terms of aluminium, the market is seeing extreme physical shortages, especially like grades like 10s that are being used in ADC 12. So that is completely short in the Indian market, and the prices have gone to record levels. So this is what India is actually looking at now as extreme shortages alongside the increase in the exchange prices and all. Yes.
Yeah, thank you. Thank you, Neha. Sandeep, let us get your cross-metal risk assessment. Looking across all base metals, which do you see as the most price vulnerable to a deepening disruption, and which is most insulated? And is the market pricing the risk correctly, or is sentiment running ahead of fundamentals?
Interesting question. Um, sitting here in Mumbai, when I look at the world, the news stories everywhere, I get a sense of the pain that everybody has. But only when I heard Rajasekar ji and Sanjeev ji, I could feel that pain. Although I can't share it, but I can understand how much pain this industry is really going through. So if you're talking about the deepening disruption, it's something that we have not experienced so far. Maybe it's going to be much bigger than 2008. Maybe this generation of businesses and investors and traders have not seen it, have not sensed it. But let me put a perspective to this. I think this is far bigger than basement. And let's understand this. Take a moment to understand the gravity of the situation. Nearly 15% of the energy supplies of the world is cut. It is as good as cutting 15% water supply in your house. You can adjust for a day, 2 day, 3 day, not for 40 days. It changes your lifestyle. You have to destroy demand. You have to make permanent changes, and it can be very painful at times. So we are in the 40th day of this disruption. The oil supplies have been cut, and oil is not a source of energy for the industry. It is an industrial product as well as a consumer product, as well as a pharmaceutical input, as well as a chemical input, as well as a plastic input, is goes across the industry. So this disruption is huge. Now, I gather from data, I'm not an oil expert, but I gather from data that the floating inventories of oil have been depleting. And now the world is going to see the shock. So we can now lean upon the strategic reserve, which not every country has, but many countries have. And that too is not a lasting reserve. That could last for a week to 3 weeks to 4 weeks. It can't last forever. So this is a shock. I don't know whether we can compare back to 1970s. I'm not sure any of us have experienced 1970s. We have only heard lesser the stories of 1970s. But this shock, if it persists the way it is continuing, and the disruption extends, then this can be devastating. So we're going to move away. first time the disruption happens, you look at the supply side stories. Oil prices go up, aluminum prices go up. You look at the disruptions and the shortages. But the second round effect is more enduring, which is the demand destruction stories. Now, that to me has already started. So I'll give you the example. If you look at vehicle sales, automotive sales, especially in the Western world, is already slowing down. So the American vehicle sales is down by 2-digit percentage. The European vehicle making companies are already complaining it's going to be a negative year for them. In China, the EV sales, which was the bulk of the sales, which was stimulated by the different incentives that the government did last year, that has closed out this year, or rather halved this year. So EV sales have been contracting as well. So automotive market all over the world has been slowing down. And let's not forget that Trump had put in tariffs, 25% tariffs on automotives, and the auto majors did not pass on that tariff to the consumers. They were bearing the load of it, burning their cash. Now they're passing it on slowly and gradually to reduce the shock on the consumers. So the automotive market, which is a consumer of many metals, especially aluminum, steel, is seeing a slowdown. And especially this, when the fuel prices rise all over the world, human mobility starts to reduce, the preference for buying a personal vehicles comes down. This is giving the first shock. So if we are talking about deeper shock, if we are talking about oil prices going even high, let's understand another aspect here. What has been the record high oil price? $148, $146 to $48, right? What is the price Brent oil now? $110. And how big is this crisis? We have not seen such crisis since 1970. That means so far, there is a good amount of hope built in the futures prices that things will kind of ease out. But the physical market does not work on the futures market. And I think we talked about this, that the futures market can have a combination of hope and reality, while physical market runs just on reality, the demand versus supply as of now. So the Brent oil in the physical market is trading at $147, while futures is $110, right? And the same as like the Asian crude basket is trading $131, while the WTI is $110. So you can see the difference. And the same thing applies to, let's say, aluminum, where the premiums have gone up. MJP is $353 above already lifted 3-month price, and you add backwardation to it. So that tells you the physical market is under so much of stress already. Any further stress would destroy demand. So to me, if this war really extends and get deeper, more entrenched, we are in a demand destruction phase now. And this would mean that all markets, investors in all markets, have to adapt themselves to the new reality. It may happen gradually, or it may happen with a shock. We don't really know. Okay. So which metal will get affected? So, as Neha mentioned, you have lead on the one hand, which was already suffering from supply surplus. And therefore, the prices did not move that much after the Gulf War. Then you had nickel, which had many years of surplus, although this year could be a deficit year, but many years of surplus. And therefore, the prices did not move that. These two metals have not seen that much of investor movement or investor engagement. To me, these would be least affected. The two metals which will be most affected is going to be copper and aluminum. Copper, because copper is Dr. Copper. It is representative of the global industrial cycle. So if we are in a global slowdown, a global recession phase, then copper has to accept that reality, especially when the global inventories of copper are already at multi-decade high level. Aluminum, because a lot of investors over the last few months have got into aluminum, seeing that story. We had this China 45 million ton cap story, and then we had this dollar weakness story, and then we came up with this Gulf shortage story. The story came on seamlessly for aluminum. So the investor built a very large position. Can you believe that now, when aluminum prices are not even close to what it was in 2022, the speculative positions are far, far higher than what it was in 2020. People are very large bet this aluminum will keep going up. So, and aluminum is a metal which is used much more pervasively. It is used for airline industry. It is used in beverage can, in the consumer industry. So it has a much wider use as compared to copper, which is used more in the electrical segment. So from that point of view, I think any demand shock, any sense that a global recession is upon us, that would pull down aluminum and copper both together. I How much market has priced that in? I think market has started pricing in. And so if you look at aluminum prices are not going up to $4,000, right? Despite we knowing that before this weekend, we had a major strike on EGA, and EGA is one of the largest smelters, and EGA is the largest producer of aluminum in the Gulf region. So, and they have suspended output. So, despite that, the prices have not reached to $4,000. That tells you that market have started understanding that there's a demand destruction happening together with it. However, I would put it this way that if you look at where futures market is, where equity market is, where US dollar is, where other assets are, if you put all of those together, I get a sense that there is still a good amount of hope built in that this war is about. There's not too much of length left in this war because the two sides are kind of hurting each other so much that they have to come to a resolution. But this hope will start to fade quickly as oil inches up. As you see, $100 has become a base now. It's become to 110. It moved from 100 to 110. We didn't even notice. It's not even a headline. It was to 120. We didn't even notice. But this is creating the ripple effect because now this Brent oil futures prices are catching up with physical prices, which is already high. Okay. So to me, I think war extending by a week is bigger pain, and extending by another week is going to be much bigger pain than the previous week. So every week is going to be compounding problems, and if it extends till end of April, I see very, very good sign of a global recession.
My God. Thanks for giving a vivid picture of the ripple effects that the industry is feeling now, the world is feeling now. Incidentally, our poll question, the upcoming poll question, Simran, if you could just display it. It's something on the same subject. And we are just asking the audience to predict how long this war could go and how the impact would be. So the question is, how significant do you think the West Asia disruption is for base metal supply chain? Is it going to be a temporary blip? Markets will normalize within weeks? Or is it going to be a short-term disruption leading to, say, 3 to 6 months of disruptions? Or is it going to be a serious structural shift that will reshape the trade flows? And is it too early to tell? Simran, can we have the results? All right. Most of them, like close to 57% of them, have predicted it to be a short-term disruption lasting for 3 to 6 months. Probably the audience are seeing this as not is serious, but maybe manageable. This brings me to Mr. Rajasekar. We are running out of time, so we will have one quick round of questions to all the panelists, and then we will open the floor for audience. Mr. Rajasekar, do you think this disruption, are you seeing early signs of trade realignment? For instance, increased sourcing from Asia, Europe, and Africa?
Kirti, we already see that the realignment is already happening. See, realignment in terms of shipping, realignment in terms of sourcing, whatever it is. We already see that realignment is very much visible. But I see the two things. One is, the cargo seeking an alternative route, wherever possible, including corridors like Cap of Good Hope and the ports that can absorb, diverted traffic, like Kofakan. Of course, they're not able to, cope up with that. But wherever it's possible, the cargoes are finding its home there to find an entry into the end point, wherever it's supposed to reach. We've also, some of the places, when the cargo was called into Jebel Ali, but it's been offloaded at different places and tried to diversion or, moving into the Oman Gulf was very much visible. Second, we also see the buyers are, widening the sourcing gap. Not because those alternative routes are cheaper, it is more reliable, at least executable, which is not the case today here, in this Persian Gulf. So if the disruption continues, I expect more sourcing should continue happening for Indian buyers. EU is already one of the major suppliers into Indian market. Today, India is trying to take as much as metal from all the places. So it's a question whether this gap can be substituted from a different place. But Indian buyers are already spreading their risk in terms of sourcing. But it won't be frictionless. The replacement will definitely come with a longer transit, higher holding cost, and there's going to be a more pressure on the contract design, how it is being designed from a shipment perspective. Yeah, that's good.
Yeah. Thank you. Mr. Sanjeev, coming to you. We had an interview earlier with you when the war had just started, and you had predicted that this will be probably a short-term disruption. And what do you resonate with the audience poll? And while you're answering that, I also want to post you the next question, which is the industry has adapted to every crisis before, and each time it has found a new normal. But the businesses that came out strongest were the ones that repositioned early. So what should market participants be doing right now to reposition their trade relationship, commercial terms, and risk strategy before this crisis ends? Sir, you're on mute.
So to begin with, I maintain what I said, 4 or 5 weeks back when we spoke, and I stay. I'm basically an optimistic person, so my optimism has not diluted. Still, fingers crossed. I think everyone, not only me, but everyone in the trade, not only in this trade, but in general, is wishing that this conflict ends amicably, and the situation is brought back to not the normal, but say the new normal. This is. I think it's still too early to predict anything, but in this kind of uncertain situation, I would recommend everyone to go back to the absolute basics of, first of all, totally avoiding any kind of speculative activity, because speculation can either make you very rich if it goes your way, or it can make you a pauper. So avoid speculation. Go by the basics in the sense. Look at the terms of your contract, whether you are buying or you're selling, to make sure that you remain you remain relevant. You cannot be too kind of strict on your terms and conditions of buying and selling, because then the business will not happen. But at the same time, there is no need to really go in for risky decisions and be adventurous. So sticking to the basics is very, very important, in my opinion. And say particularly for Indian customers and Middle East exporters, this is the relationship that goes back many years, Indian industries are treating GCC suppliers as the backdoor, the next door supplier, because the material reaches very fast. And I'm sure this will continue. The current disruptions are not going to be permanent, but this is an opportunity to do a lot of learning and evaluating your processes, your systems, just to make sure that you don't leave any any gap, an obvious gap to make a big loss.
Right. Thank you, sir. Mr. Sandeep, what concrete steps should they be taking, the buyers and traders, right now on procurement strategy, contract structuring, and hedging? Your closing remarks, in fact.
Right. Yes, I think as all the panelists really talked about this, I think there is always a need to diversify. Diversify, I would say, in three ways. One is obviously the vendors and the customers across region. That's one. Secondly is, if at all it's possible, get a mix of secondary and primary as a feed. Certain industries can do that. It always helps reducing that, because these two segments of the metal industry have their own cycles sometimes. So it always helps having a feed mix. And thirdly, to have a mix of the energy feed. Many industries, let's say in India, have been affected by shortage of gas supply, right? But those who have access to alternative fuel feed, they are doing better off. So, and a preparedness, a readiness to use a mix of energy feed is a good idea for the industry as such. The panelists Rajasekar and Sanjeev really talked about this, that force majeure clause are obviously the last clause to be exercised. And most of us who write the legal clauses, they don't even look at the gravity of it, the real meaning of it, because we know this will be only once in a blue moon that will be used. It is a paper to be filed, and let's go back to the business, right? But these are the times when the languages are tested. So it's very, very important that we rightly put the languages, if at all, take help of advocates in order to write in a way that it protects your interests completely. There can be two impacts of war. So one is direct on you, a second could be indirect, because suddenly the premium has shot up for a reason which is beyond your control, which has happened because of a force majeure event, but which is not directly affecting. You should have certain clauses written in a way that although the force majeure is not directly invoked for you, but there should be a room for renegotiation in these times with your supplier vendor, so that there's a flexibility on this. Third thing, those people who do not hedge, it's very, very important to introspect. Do not lose this opportunity of being more learned about it. At least get your feet wet. And therefore, a good understanding of how hedging works and how it can help for you. Even if you start with 10%, 20%, 30% of the portfolio, prepares you for a day like this, for an event like this. You start, having the full effect or full learning of the hedging for you, working for you. Those people who are hedging already, they have seen a different kind of risk, which is that the inventory is accumulating, right? So the hedging volumes are rising, your short positions are rising, and the prices are moving against you, right? So you need more collateral to fund your mark to market. That's a different experience altogether, and how to handle that. So you have to have the rules written as to how you would handle these kind of situations. There can always be a lot of debate and discussions for how to handle the situation. But once a situation like this comes, it makes you more experienced of handling those high volume. How you handle it? Have more brokers, more collaterals, more credit lines, so that you can keep your hedges. There's one more question that comes in, which is a debate, which is whether you should hedge your inventory, right? So every industry would have. So traders are different because they practically have zero inventory. Everything they have needs to be sold. But for industry, they always keep a bare minimum inventory, which could be their WIP in the plant, whether that should be considered as a fixed asset because they're never going to sell that, or that should be hedged. Because when you hedge it and the prices moves against you and the cycle becomes far bigger, the mark to market losses can be quite big. So there has to be internal discussions that whether you want to hedge it, and if at all, whether it should be a fixed hedging or dynamic hedging, how you can support in different price cycles. More importantly, amongst all of this, my request to everybody is that please let's start acknowledging, let's all of us start acknowledging that nobody can predict prices. And these prices can swing from one end to the other end with just one tweet or one headline, with one development. And so let's get more balance. The businesses are done in a way that you make money every day, irrespective of the prices going up and down. So create a business where you make money every day, protect your margins by doing hedging rather than speculating.
Thank you. Thank you. And Neha, the last word to you. Even if the conflict ends tomorrow or today or this week, many of the supply disruptions and price impacts are likely to persist. So what lasting changes should buyers, traders, and market participants anticipate and be prepared for?
Yeah, so just like we saw the audience poll and then like what the other panelists mentioned, even if the conflict ends tomorrow, the impact won't disappear immediately. Some changes are likely going to stay for a while, and first, logistics will remain tight for some time. Shipping routes and freight rates, insurance costs may take time to normalize, so the higher landed costs could persist. And secondly, the buyers will likely shift towards diversifying sourcing rather than depending heavily on one particular country or just, especially like Middle East. And thirdly, the inventory strategies will change. Many players will continue holding higher buffer stocks and manage uncertainty. And finally, the volatility here is to stay. Even if the supply improves, the market will remain sensitive to disruptions. So overall, I think the market may move from being just cost driven to more risk managed and supply secure focused going forward. Yeah.
Right. Thank you. Thank you so much. And we have come to the end of this discussion, but now we are opening the floor for audience questions. I request the panelists to be stay back and answer some of them. The first question is from Julian. He has asked everybody, are you already seeing cargo being abandoned due to demurrage exceeding cargo value, or which ports are currently under most pressure? I think Mr. Sanjeev or Mr. Rajasekar could answer this.
Let me take this. Can the questioner specify when he says demurrage and detention? Is he talking about the cargo stuck at the load port, or the cargoes are which have reached destination? Because we have heard of some complaints from importers that shipping companies are charging surcharges on those arrived cargoes, even though they are out of the this location, and therefore naturally there is a question as to why they are being asked the surcharge. So can the questioner
Julian,
clarify that?
Yeah, Julian says it's both load and transit.
Yeah, okay. So see, as far as the load port demurrage and detentions are concerned, it is too early to really say anything, because as far as my experience goes, we are yet to receive any invoices of the demurrage and detention for the cargo for the containers which were at the port. But yes, coming to the demurrage and detention on containers which have not been released by the importers in respective destinations in India or elsewhere, because the shipping companies are charging extra cost. In the event that we held a week ago, it was made very clear by the maritime legal expert that the surcharges need not be put only and only if the ship is in the location of conflict. Even if the ship directly or indirectly has had some has been affected by the conflict, the shipping company is within its right to put surcharge. And this could be for the higher fuel cost, it could be for the higher insurance cost for shipping company themselves, it could be for